Thank you, everybody. While my fellow panelists are going to sit, I also would like to thank a bunch of helpers, in particular Cynthia, Glacy, and May, that actually made this conference actually happen. We get the credit, and also thank you to the AV team for clearly making this. So now I'm going to switch my head. And I have kind of the pleasure to opening the conference with three fantastic, actually exceptional women. They're not only wonderful professionals, but actually also a role model in their own rights in this profession. So to those who say you cannot find a woman that talk about fintech, AI, and digital inclusion, look hard. Again, they're actually top notch. Given I'm not going to do it justice, I asked them during the first question to introduce quickly themselves, but also let me set the stage. Again, this is the panel, and I asked them to be bold and to actually lay, if you wanted, a challenge to all of us, whether it's practitioner, multilateral, or actually academia, to very much what we wanted to accomplish here. But also, if you think about, if you're doing this conference in next year or 2 years from now, what success should look like, but also how far away we are with success. So this panel is supposed to be really bold, and I hope everybody is going to be equally daring in kind of very much lay the challenge at the foundation. So again, I'm going to stop speaking, and so I'm going to ask first Hinka to quickly introduce herself, but also to kind of talk a little bit about the role of financial inclusion, digital technology, and AI, if you want, the big data revolution, how has it live up to the expectation where it potentially has fallen short? And so where is our work left to do?
Good afternoon, and thank you very much. So I'll start by saying that Laura has said we should be bold. So anything I say here is being bold. Thank you very much. So my name is Yinka David West. I'm the Associate Dean from Lagos Business School in Nigeria. And I also lead an initiative called the Sustainable and Inclusive Digital Financial Services Group. And what we do there is really research and advocate financial inclusion. I have a specific quirk because I work in digital, financial services, and tech, gender. So I sort of look at the confluence of all three. One of the things Laura has asked us to talk about is it myth or hype, right? And I think the jury's out on whether digital technologies are the magic bullet for financial inclusion. I think with digital, everything is myth or hype, depending on how you want to see it, because I think that you have to understand that one of the things about digital is, if I build it, will they come? And that was the theme of my inaugural lecture. It's not as easy to build a digital product and have everyone just join in and adopt it. So whether you like it or not, there's still other things that are non-digital that are required to drive digital adoption. With financial inclusion, we've seen globally that mobile money was a catalyst to enabling financial inclusion since the Findex record started in 2011. But then again, we still have 1.4 billion people outside the financial ecosystem. So what's the next magic bullet? Is it digital assets? What will it be? Is it crypto assets? We don't know. And I think that's really what we need to solve for. Is it going to be a mixture of different digital technologies? Is it going to be artificial intelligence or blockchain technologies? We don't know. And I think that's really the challenge that we have to face, that 1.4 billion, and it's growing because as populations increase, especially in global South countries, we're still going to have a lot of work to do. So I think I've done my introduction then. Yeah, fantastic. Thank you.
Edom, do you mind? Sure. In part because this is perfect segue to some of the discussion that you and Ed on this topic.
Highlight those. Yeah. So thank you very much for this opportunity. So my name is Edom Tsegaye. I am part of the financial services for the port team at Bill and Melinda Gates Foundation. So within that team, our strategic goal by 2030 is to ensure that 80% of adults are globally financially included, and of which about 60% of them are earning less than $2 per day. So with that objective, we truly believe that we can only accelerate that by leveraging digital technologies. And it's not the silver bullet, but it is definitely one of the accelerants in our perspective. So we do global level work. And if you look at the current status of financial inclusion according to the Findex that came out in 2021. If our team's goal is 80%, global level, we are at 76%. So you might say, oh, your team will close up shop in a few years. That's not true. There's still a lot of work to be done at the country level. I can tell you, we focus on 9 countries in Asia and Africa, and I covered the Ethiopia market. In Ethiopia alone, the financial inclusion rate is just at 46%. And Yinka can tell you they're probably at 64% in Nigeria. So there's still a long way to go. And the conversation so far has been around access to financial services. Now that needs to shift over time to talk about usage of diverse set of financial products and services, but also for us to start talking about the quality of products and services. So now, Laura, to the second question you mentioned, what is this hype about, and does it come with its own shortfall? I agree with the Yinka in saying that it's a bit of both. And Laura is mentioning the one experience that's mostly talked about, which is the Mshwari story in Kenya. So this is along the lines of digital lending. So digital lending has been this phenomena over the last few years, mostly because it's being driven by fintech companies. So it's mobile first, it's small value, it's short-term loans, and it's uncollateralized, which makes it very attractive for low-income households. So these individuals otherwise wouldn't even either have access to credit at all, or alternatively, they would have to be subjected to what the loan sharks are willing to offer. So when you're faced with such a scenario, digital lending platforms tend to be very attractive. And they're also relatively affordable. And I say this with a bit of a caveat, because in some markets, we've also seen that they could be predatory. So why is it affordable in the first place? So you're talking about these platforms leveraging electronic KYC. So that definitely brings down the customer acquisition cost. They're using AI-based credit scoring platforms. So that is replacing the traditional underwriting process. They are dispersing money digitally. So digital definitely comes with a big value. And then they're also doing the collection through e-mandates or pool payments. So the combination of all these features allows them to offer the products more affordably. But then now on the flip side, you start hearing stories of high over-indebtedness, debt shaming, which is actually a tactic used by digital lenders to pretty much tap into your social network and make you feel like you are useless because you have not paid your loan. And you find them in this vicious cycle where they have to borrow in order to pay their previous loan. And then you just end up being in this vicious cycle over and over again. And then it also comes with different forms of harassment. So what ends up happening is it's good on one side because people are getting access to credit that they wouldn't otherwise have. But on the flip side, it comes with its own harm. So there are a number of things that we can talk about in terms of what policymakers should do, donors should do, and we can discuss this later. But regulators, I believe, have a big role to play in this. And maybe my panelists might disagree with me on this, but I'm happy to debate.
Sophie, you want to quickly introduce yourself, and it's the glass half full or half empty?
So I'm Sophie Sirtaine. Thank you very much for having me today. I'm the CEO of CGAP. And for those who do not know, CGAP is a global partnership that's housed at the World Bank Group. It works towards, as a think tank, towards studying, understanding, and promoting new solutions to foster financial inclusion. So on the spectrum of hype to myth, I'm definitely on the positive side. But largely, so you talked a lot about why digital financial solution and fintechs can help with financial inclusion. I would place that even at a higher level and just reflect on the fact that in a way we have no choice but to see the hype and make the hype succeed. And that is because the world is going through a really difficult phase at the moment with all the shocks that have happened over the last few years and threaten to intensify. We know that only 15% of the SDGs have been met. We know that there's been reversals in poverty and equality improvement trends. So fundamentally, a world is neither socially nor environmentally sustainable. And I actually truly believe that inclusive finance in general, but fintechs and digital innovation in finance have a role to play to put the world back on track. And I'm not exaggerating this. I think we really have a role to play. You have studies by UNDP, for instance, that show that, of course, digital development can contribute to at least 70% of the SDGs. We have done our own work with Queen Maxima's office. She's the special envoy for financial inclusion of the UN Secretary General, as well as other institutions like BTCA and the World Bank, to show that financial inclusion can contribute to at least 13 of the 17 SDGs. And intuitively, this is quite obvious. Without financial services, you can't build resilience to shocks. You can't have cushions to prepare for shocks. You can't adapt to climate change because you can build you can buy the new tools or move to a new livelihood or do whatever you need to do to adapt. You can acquire green technologies and participate in a just transition. If you're a woman, you don't have your independent decision-making abilities and agency. And in terms of inequality, financial inclusion is about prosperity, opportunities, etc. Now, shall I continue with the hype and the myth? Because
of regulation and why this has to happen in a sense, as you said. Yeah.
The hype, because I think fintechs has actually delivered on quite a lot already. Where we see the best use cases, it's really around first and foremost credit scoring. And there, I think based on alternative data, we've done research that shows that 73% of the poor are now digitally connected, so they generate data trails, but only 67% are financially included, only 25 save, and only 12 borrow. So just there, you see that if you leverage those alternative data trails, you can really bring a lot of poor or micro firms into the financial system. And that is happening through, as you mentioned, KYC, customer due diligence on the basis of alternative data, credit scoring. You also see quite a lot happening on the climate front, but exclusively with regard to index climate insurance. We also see quite a lot on interfaces and client relationship with chatbots, with biometrics, etc. But where the potential has not been met, but potential exists, is in many other dimensions. One is in understanding better your clients. So client data analysis powered by simple analytics or AI is potentially really powerful, because we know that one key obstacle, especially to women's financial inclusion traditionally, has been the lack of tailoring of products. Claim handling, for instance. A lot of banks and other companies have limits on the transaction amount for which they would simply, process a claim because it's just not, commercially sensible to do it otherwise. But through AI analytics, you can lower that threshold and really make it actually possible to lower the claim handling threshold. Insurance. 6% of the demand only is met. Again, AI or alternative data for claim estimates, or for processing, or for to spend money, to send money before and prevent climate shocks. All of these are potential use cases that are barely there. And I think there's a lot of obstacles, but I'll shut up now and come back about which now.
Actually, so that's where Sophie and I kind of share a little bit more optimism, in part also the recognition that it's becoming a world of those that have and have not. So this notion of connectivity, the digital transformation, whether it was fast-tracked by COVID, was already on the place. And that's why we are discussing fintech, AI, and digital transformation in one breath during this conference. It's very much because they're intersected. And the other elements is very much this notion of data. Now you have people that have access, even a digital infrastructure, access to this service, and those that are excluded. Now, I know that in previous conference, I was on a panel, somebody's like, oh, Africa is not even connected. For those that's not the case, remain challenged, but we are not talking about essentially a developed versus developing country debate. So now, again, even if you take these, whether it's the less optimistic and more like the burden, the proof is still out there, or the more optimistic in the case of Sophie and myself, they think like this has to happen. There is, in a sense, there is no choice. And if you want to kind of shrink inequality and kind of have an economic prosperity, this has to happen. What is the role of regulation, if you want to, even policymaker, in very much enable an environment where this can happen, whether it's like from the risk, infrastructure, or even regulation? Edom, do you want to start?
I could briefly touch on that and give my panelists a chance. So when it comes to regulation, it's a bit tricky, right? So regulation and innovation is kind of like a chicken and an egg problem. So, I mean, some might even say we wouldn't talk about M-Pesa right now if regulation came ahead of innovation. So when it comes to regulation, you kind of have to give space for innovation to take place. And this could be done through a sandbox approach where you can minimize the risk on the market and do it in a very controlled environment. But then at the same time, as a regulator as well, you kind of need to put yourself out there and spearhead the innovation conversation happening at the industry-wide. And one example that I can think of is India. So India's central bank has been, I think, over the last few years, has been in a place where they crack down on Aadhaar and UPI and whatnot, but then have also created space for innovation and now have fully embraced innovation and have created a subsidiary that is linked to the central bank. So they're calling it the Reserve Bank Innovation Hub. So this is a central bank that's giving us an example where you could be a regulator and pro-innovation. And in some cases, when it comes to regulation, they have to step in. So if I may go back to the Mshwari story, what the Central Bank of Kenya did was, one, they completely had to remove the unregulated digital lenders. And in fact, there was even conversation with the likes of Google to say, should we remove them from Google Play because they are doing a lot of harm within our markets. They've also taken an extreme measure of capping interest rate. I think that actually hurts the market because you really want competition to drive down the interest rate and affordability of the services rather than playing that kind of role. And then in some scenarios, there was also a number of defaulters that were blacklisted on the Credit Reference Bureau for less than $1. So that is extreme because once you're blacklisted, one, you can't get access to any other type of loans. It pretty much hinders your ability to grow your income and economically be empowered as an individual or a household. So in some scenarios, central banks need to intervene to do some course correction. But overall, I think they need to be in favor of innovation. And that is the only way to go, because as Sophie said, we can't stop it. We need it. It needs to happen. But how can we do it in a more responsible way?
Sophie, do you want to?
Maybe I'll build on that. With everything you said, I'll just build on that. Fundamentally, if you think about the role of a regulator, is really to balance, on the one hand, what's going to enable the market to flourish, which to me is really anchored around two concepts, innovation and competition. And on the other hand, provide protection against all the risks that you've mentioned and that are real in this market. And so how do you do that is quite actually difficult in a rapidly evolving financial services landscape. But on the competition side, what we've observed in markets like India, but also like Brazil, for instance, is that if you have digital public infrastructure that are interoperable, that allow third-party initiation, instant settlement, so allow basically fintechs and other players to participate, to compete with banks. That typically creates a lot of more incentives for everyone, not just for the fintechs, but even for the incumbents to go down market and innovate. On the innovation front, sandboxes are fundamental. We fully agree with that because you really need to leave the space for fintechs and others to innovate, to test, to pilot. But we also believe that data sharing frameworks are fundamental. And by that, we mean the type of open finance framework that, for instance, Brazil has put in place, but all high-income countries also have done that, and India has some form of it. But these are frameworks that enable basically customer to own their data, including their digital, of course, data trails, and to decide whether or not to share them and with whom in the financial sector. In general, forcing basically banks to release data and enable fintechs or other innovators to use them to develop these new use cases, new products that we talked about before. We find that that is really transformational. And in Brazil, in fact, financial inclusion numbers have really risen after such system was put in place. So that's really on the enabling side. I think what is missing on the enabling side that is not really from regulators, but for policymakers and others, including for private investors, is the funding side. But maybe we can talk about that after, because few innovations have actually scaled, and we really need patient capital. That's why I see the key role to play here, because we really need patient capital to enable that to happen. But all of this needs to be combined with protection. And that is because in a digital world where new low-income individuals, small firms with typically lower digital and financial literacy are being served for the first time, risks are increasing dramatically, whether it's data privacy abuses, whether it is cybersecurity, or just all sorts of frauds. Our research, for instance, shows that in Senegal and Côte d'Ivoire, 80% of new users of digital financial services said they were the object of some kind of fraud and scam, and 40% said they lost money because of it. So you can't take it non-seriously. You really have to address that.
It goes even farther. So digital micro work in Africa across 7 different countries was a study. Over 50% gets unpaid. So now you have this kind of side of the economy that you take on the risk to even engage in the work. Sorry, Sophie, go ahead.
No, so I was just going to say, so consumer protection frameworks need to be significantly scaled up, strengthened, and probably rethought, because they're not ready to address the kind of massive, frauds that cross borders, cross financial sector boundaries, because they come from non-regulated entities, etc. So that's another very important regulatory, I think, challenge that we're facing.
Inka?
2 things for me. I think first is people, because the roles everyone plays is really about, they play different roles, but your mindset, your mental models also limit how you think and how you're open. Regulators see themselves as enforcers, not really enablers. So we need to begin to change these mental models. The second thing we need to be mindful of is you can't give what you don't have. We're asking regulators to monitor a digital marketplace when the regulators themselves are very analog. And so how do we do that? So we need to also realize that the regulators need to think about their own digital transformation. How do they think around regulatory innovations? Because all the things we're saying, honestly, they don't have a clue. So we might say use data, use open banking. How do you really broaden that awareness and that knowledge to ensure it's effective? Because that proactive type of regulation that we need, really giving early warning systems rather than looking behind and saying what happened, we need to be saying what's going to happen. They're not really at that level yet. So data use, RegTech, SupTech has to come from them. And then they also need to realize that to enable the market and to make the market stable, it's really up to them in terms of how they use data, how they develop all the other tools or whatever we want to talk about innovation. Because if they don't innovate, then the market is going to continue innovating and that gap is going to continue widening. And then that's where the risks, because again, when, you know, in Nigeria, for example, we have about, we now have 800 microfinance banks, but we had about 1,000 something. And then the ones operating in rural locations, sometimes the regulator wouldn't even know when they closed. So you realize that the supervision capability also needs to be enhanced so you know what's going on and you can truly protect the customers, because it's not just the fraudsters, but when these institutions go out of business, that's also a kind of fraud in that sense. So there are many things, especially rural locations, where most of the more vulnerable, more underserved are living and existing. How do we ensure that they're not also cut off in that sense? Thank you.
So can I push the tree a little bit more on infrastructure? So we all actually touched upon in different contexts, but one infrastructure is the education infrastructure. Again, you think about the regulator, the supervision that doesn't exist. But how far away are in insurance we have the infrastructure and the product for the people that needs to use it, for which we need to close that gap? Sophie?
Well, I'll start with the basic, you know, connectivity is the basic infrastructure that is still missing. I think you still, yeah, exactly. So you still have 2.6 billion people who are offline in the world today, which is striking. And I think that while you have 90% of people using internet in high-income countries, it's 1 out of 4 in developing countries. Then coming to your point, smartphone ownership is still limited or not affordable. And the data from the World Bank that I have in mind is that the average cost of a smartphone and connection in a developing country is about 16% of the monthly income. That's huge. And for the 40% poorer people, it's 44%. And for the 50% poorer, it's 55%. It's like half your money would go on your smartphone. That says it all. You also have 850 million people who are still without an ID. And you still have 5 billion people who live in countries that do not have digital ways of unique identification numbers, basically. So start with the basic infrastructure. And for me, that's the most important, because everything we talked about is about leveraging digital data. So if we don't bridge the digital divide, as it is called, we're going to push these people behind. So I'll stop there. I mean, there's so much more that can be said, but I want to give you a chance.
You can build on this and create a laundry list of things that needs to be done. But I fully agree to Sophie's point. And then maybe other types of infrastructure that you think is critical is interoperable payment infrastructure, because that would definitely bring down the cost to serve individuals. So that's, and then the other type of infrastructure, which is not your typical technology, but agent networks. You need to have agent networks across countries because they are the touch points, especially for those in rural areas and hard to reach areas. One of the reasons that is commonly cited in Fintech's report as to why people don't have accounts is because they would have to travel far. In some cases, they would have to skip work to go access their money. So just think about the difficulties just to take your own money, your hard-earned money, and use it to meet your financial needs. So, I mean, we can go on and on. There are different types of infrastructures, which are the digital rails that needs to be in place. So if the way actually we structure our work at the Gates Foundation is we have 3 building blocks. So the policy and regulation, the infrastructure, and then the last piece is the private sector development. So you need to have those in place. From a sequencing point of view, you kind of have to do all at the same time. Yeah. Depending on where a given market is at, you might focus more on one over the other, but ultimately, these we think are the 3 ingredients.
Inka, I think Nigeria is one of the most fantastic dynamic country, but also has this kind of massive divide. One side is one of the frontier of the digital innovation. On the other side, when you talk about rural, your point was, and affordability becomes the key. Do you want to talk us?
Yeah, I think every market needs to understand its own dynamics and create a strategy for inclusion that works for that market. Whether it's a digital or a phygital strategy, it depends. But I think Nigeria is also one of those anomalies, right? When you think about it, we've got a lot of fintech money coming in terms of venture capital funding. We've got a lot of players and actors coming in. We've got instant payment systems. Even before the US and other European countries, we do things like account number verification. So you get an account, it goes and queries the system, so you know who you're paying it to, so you know name and number matching. But then again, we still don't have what I call micropayments, right? Because it's still expensive to send low amounts of money to different people. So how do we crack that? Because then we don't have acceptance models across different use cases. So for me, I can go into a formal store, a supermarket, and use the card infrastructure. I can use the transfer infrastructure, but people need to pay for transportation. We don't have that infrastructure available or those systems available. They need to pay for food, street food at the street markets. So those kinds of merchant acceptance systems need to work. Nigeria forayed into a CBDC, but then again, we're still not there yet, okay? But it's just, there's a lot of technology out there, but we also need to sort of take a step back and decide who is leading what. Are we putting the cart before the horse, or are we just going to sort of continue buying technologies to develop in? So the infrastructure rails, for me, before we even get to digital, it's also energy. A lot of people are still living in energy poverty. So how do we ensure that those rails get there? The financial infrastructure, Edom mentioned agents, they still need to rebalance. If an agent needs to take a day off to go and get money from the banking system, it's still back to that chicken and egg. So I think it's there are different siloed things that cut across the sector. So how do we sort of bring it all together and aggregate them and ensure that as we're solving, it's almost like a system view. We're solving, but we're not also creating more unintended consequences to ensure that people who are further left behind.
So if I can summarize all of you, there is a last mile problem where that last mile can be affordability in terms of income distribution, can be merchant infrastructure or agent infrastructure. And so while there is a lot of hype, if you want, or a lot of even in Nigeria, hype around technology and what is the next best in technology, we are still kind of living last mile problem a little bit behind. So, and this is going to be the challenge, and I want to utilate a challenge to our field as a researcher, as a practitioner, and as a people that work in this space. What does success look like? So if we're going to have this conference in 3 years, and I'm going to make it 3 years, probably it's too long, but if we were to have this conference in 3 years, we're going to have the same panel. How can we say we are there, or what success, or we are on the way to success look like, and what potential failure could look like? Inka, do you want to go first?
Okay, I think for me, success is safe and inclusive systems that work. And when I say that work, that also means systems reliability. And these systems must be built for scale. So in Nigeria, for example, we have outages, right? We have, you have debits, and then your account has been debited, but you don't get value. And then all the customer protection and complaints management process has to work as well. The second thing I think is we need to think about inclusive fintechs. Now, we've talked about fintechs, but for me in Nigeria, we're still not there yet, because the way we see fintechs is that they're complementing and providing alternative services that the banks aren't providing, but they're not really deepening or going down market. So any fintech that comes to tell me, I'm building an app, and I'm like, oh no, they're only building for 25% of the market. How do we ensure that we're really building for the entire addressable market? The other thing is we need to be more mindful of the diffusion of innovation and how that works across markets, right? Because everyone is going to take their time to understand. So that's where the education component comes in, cybercrime component comes in. And then how do we, again, as regulators, interagency and intra-agency collaboration and cooperation? It's easier said than done. And I can tell you that sitting in a room of regulators in Nigeria, 20 of them from 8 different institutions, they don't really understand financial inclusion. They understand their mandates, but they don't understand financial inclusion and what the overlay is. So how do we educate them? Because we're trying to get them to change a phenomenon. All they're looking at is, but my mandate says I must do A, B, C, D, E. So there's a lot of work to be done in those markets, and we just need to continue pressing forward, but it's really peeling an onion one layer at a time. Thank you.
Edom?
So I didn't know that we had a shared vision and that we were on the same page.
The question is
I know.
We
We didn't rehearse this, but she literally hit all my points. So I don't need to repeat what she said. But maybe a few things that I can add to that is, you know, for policymakers to really take on that leadership role to collaborate and bring in, facilitate within the market, I think is a must. And the sooner it happens, the better, to achieve a safe and inclusive financial systems that we all strive to see in the coming few years. And maybe if I could pose one for donors, this might reflect on me and maybe a bit on Sophie, is, and Sophie touched on it a bit, but we really have to be bold. We really have to take more risk and be patient with our investments. And I say that because, to Yinka's point, there are new apps coming up every single day, new companies being set up, but they're all fragmented and they all struggle to scale. Some would say it's lack of funding, lack of talent. You would hear it over and over again. But the consolidation piece can be done by the donors to some extent. Of course, we don't want to play a matchmaker role, but at the same time, we really need to provide the capital that would allow them to scale, because the innovation that needs to be scaled and to reach the hard places, you really need capital to go to those areas. And one thing that we always talk about, what we do or how we summarize our work, is at its best, philanthropic capital is doing what government won't do and what corporations can't do.
Yeah, it needs to be social capital, though, impact investment capital. Because the VC capital we're seeing is really about go and drive scale, go and drive growth, go and drive, so thank you.
Sophie, can I also ask you to touch also a little bit about the knowledge gap? And I think Edom and Yinka also was talking about it a little, and you as well, about patience and kind of understanding which app should we, vote off the island, which one we want to keep. So do you want to kind of give us your vision of success and kind of also speak a little bit more about kind of knowledge gaps?
So vision of success first is totally aligned. Our vision statement at CGAP is that we want to see in the world basically inclusive, responsible financial ecosystem that contribute to a greener, more inclusive and more resilient future. So I think that's exactly what you said. And we see that happening through more and more governments investing in the right digital public ecosystems, everything that we talked about from infrastructure to regulation, leading the way to flourishing fintechs and partnerships between digital fintechs and digital providers with incumbents to then create more use cases and having funding that allow them to scale. So that's in a way the scenario we're looking at. But you're asking about research gaps, and I think there are several. If I'm thinking about being here, say, in 3 years, I hope that we would be talking much more about climate, because for me, that's the biggest gap, where fintechs have a key role to play and they haven't embraced it yet. And it's probably the most pressing need of our world today. And this is both on adaptation and mitigation. So on the adaptation front, basically, the day-to-day decision of a person in a developing country that is affected by climate change, and we know that that's where the impact are felt the more. That day-to-day decision about adaptation will need to be financed from access to finance, not from government social safety net that come too late and are too little and don't cover these types of slow onset changes that these people have to go through. And there's very, very little other than index agriculture insurance products. But we really need to make an effort to think about how we can develop commercially viable adaptation products for the poor. That's really not easy, but it has to happen. And on the mitigation side, there's a lot of inclusive green technologies that are starting to be cheaper than their equivalent dirty technology. So for instance, in Nigeria, I have an example from Nigeria, I hope it's correct, but our research shows that the cost of a rooftop solar generator is 1/3 of the cost of a diesel generator, which is nevertheless what people use to power their houses and their businesses. The reason for that is because there's insufficient asset financing, even though that exists and that has been demonstrated to work, to really promote the pickup, not just asset financing, but also, as you were saying, impact investment to push up the pickup of inclusive green financing. So for me, that's one key research agenda for the future. The second, I think, is about gender. We haven't talked a lot about women, but there are still obstacles that are specific to women that are generally rooted in gender norms. And that means that last mile access problem needs to have an additional intentional dimension. And I think we still need to do more research to really get to crack that nut that is still not solved for the world. Stop there.
So we are clearly out of time, and apparently I'm a terrible chair, give them 2 minutes over time. This said, I think they laid the foundation for a fantastic 2 days. Lots of work for all of us to do. And so I want to just thank you. And again, I could talk for hours with you, but I'm just delighted for your time and for your insights. Thank you so much.